Okay, good morning, everybody, and welcome to today's webinar with FX Street, which is going to be our last one before the Christmas break. I hope you've all had a very, very good 2016 and are looking forward to 2017. In today's webinar, what we're going to do is move these boxes here. You will see some little sort of hatch boxes in the bottom right-hand corner of your screen. It's just so I can literally sort of see your questions and answers coming in. The one thing I just have to warn you, if there's any coughing or anything like that, I apologize. I've got man flu this morning, so I am struggling badly. So anybody got any tips on how I can get rid of that very quickly, please let me know. Okay, so in today's webinar, we're going to talk about a trendline breakout strategy. It's a very basic, but very, very effective trading strategy. In fact, it's one of the first trading strategies I ever traded, and it's something that's always been there. Obviously, as traders, as human beings, we always have the yearn to try and improve things and stuff like that. But this has been something that sort of remained throughout. One of the strategies, one of my most consistent strategies, let's say. So that's what we're going to talk about in this webinar right here. Before we move on, as always, we need to go through the disclaimer. That's to say the content of this webinar is not investment advice and should be used purely for educational purposes only. All participants are advised to seek their own counsel prior to investing or entering into any trade. Spread betting and any other type of financial trading carries a high level of risk to your capital with the possibility of losing considerably more than your initial investment. The content of this video may not be suitable for all investors, and an individual should ensure that they are fully aware of the risks involved, and if necessary, you should seek the advice of an independent financial advisor. So a little bit about myself, for those of you that don't know me. I'm co-founder of Traders Corner, which is an educational website, basically to help people like yourselves learn to trade. We've also just very recently launched something called the Money File, and that's at www.themoneyfile.com, and basically they're trading signals. So we tell you what we're trading every single week, so you can kind of make your decisions and trading analysis based on that. We've been trading the markets, and I say we because my trade with my brother. Since 2005, we've done some consultation. It says consult for a fund in Europe here. We don't do that anymore, but we have done. And then we call for many articles for FX Street, FX Journal, FX Trader, investing.com, all of that kind of good stuff. And if you want to find us on Facebook, go to www.facebook.com/traderscorneronline. Okay. Thank you very much, Mohit. So have a whiskey and warm water. I'll give that a go. So the strategy itself, it's a very simple and easy to follow approach to trading the markets. Okay. One of the fantastic things about this strategy is it doesn't, I say the other two strategies, we've spoken about other strategies on previous webinars here, but it doesn't require quite as much focus as other day trading strategies that we teach. Okay. It's a bit of a mix. So it's a mix between shorter term day trading and longer term swing trading. Okay. So you're kind of trying to get you're not in positions for days and weeks and months, but you're also not in the trade for just kind of a few minutes. It's not one of those where if you get involved, if you're sort of waiting for a trade, you get up and walk away from your screen for like 2 minutes. Sorry. Then you would miss the opportunity altogether. It's not one of those, you'll be happy to know. It's basically, I think it's the perfect strategy for those of you that like the benefits of trading short term. Okay, but you perhaps don't have the time or the attention to sit in front of your screens for hours on end. 1 second. Burning up in here. Yeah, so it's basically a nice mix of day trading and longer term trading. So you can get lots of opportunities a week, but at the same token, it's not one of those where you have to be sat in front of your screen every minute of every day. And you can actually manage your trades on an iPhone or an iPad with this strategy here, which is pretty cool. So what is it that we're looking for? We're looking for breakdowns in the market. That's ultimately what it is. So we're not necessarily looking to trade in the direction of the longer term trend. It's helpful. They are high probability trades, but you can also trade against it. We're basically looking for trends on the 15-minute chart that are breaking down, and then you trade based on those. Obviously, if you're trading in the direction of the longer term trend, that you're going to be much more likely to get into a trade that you can hold for a significant amount of time. If you're not trading in the direction of the longer term trend, then you're going to want to take profits a little bit more quickly. Okay, so essentially you're trading the breakdown of the trend on a time frame that you're trading on, and typically we use the 15-minute charts. Okay, because we find that's a nice mix. It's somewhere in between day trading and swing trading. All right, it's also a strategy that's based on solid technical foundations that have lasted pretty much since the dawn of time. Okay, so since we've had technical analysis, we've had trend line breakouts. So what's the chart setup? How are we going to trade this? So we use a combination of regular candles, Heikin-Ashi, and line charts to make our trading decision. The 100 exponential moving average is also applied to the charts, and what this basically does, it just provides us a little bit of context in terms of the direction that we're trading in. It's not to say that, we're going to take the price crossing the 100 moving average will get us into a trade. It just gives us a little bit of context. All of the entries is based on the price itself. Okay, and as I said just now, typically I like trading this on the 15 minutes charts, but you can apply this strategy to any time frame at all. So if the 15 minutes is even too short-term for you, then you can look to trade it on something like the 1 hour, the 4 hour, or even the daily. Now we use 3 charts in total. 2 of the charts will provide us the necessary granularity to be able to execute our trades. And what I mean by that is it gets us in close enough to the markets to be able to find ideal entry points. And then we use 1 of the time frames just to give us a bit more of a high level overview of the direction of the market. So if we're looking to take a trade, it's nice to know whether we're trading with or against the trend. As I said, it's not to say that it would stop you taking an opportunity, but it would just kind of it would let you know how much profit you can expect out of it. And personally, I've fallen in love with TradingView over the last year. I think it's the best charting platform out there. So that's where we use this strategy. This is what a chart setup looks like for us. Okay, so on the top, we have the Heikin-Ashi. In the middle, we've got just the regular candles, which is typically what we execute from. And then on the bottom there, we've got a 4-hour line chart, which basically just gives us an overview of where is the market going, what direction is it trading in. So once you understand that, like I said, that gives you good information in terms of how much profit you're going to be able to get out of one trade, which is really, really important for a trader. And I see so many traders make this mistake. They use a one-size-fits-all, as in, my profit target is, 100 pips, for example. And they use that on every time frame, or they use it on different instruments. And, if you take something like the euro pound, for example, which typically is not very volatile, 100 pips is quite a lot to wait for. It could take a while to do that. By the same token, if you were to use something like the pound Aussie or the pound yen, for example, that's very, very volatile. And 100 pips probably isn't enough. You could probably get more out of the market, if you see what I mean. So sort of like not a one size fits all. So we start off by looking at the 15-minute charts, all right, for some nice trending price action, all right. Once we've found that sort of a chart with nice trending price action, we then draw a trend line along the swing lows as if it's in an uptrend, and along the swing highs if it's in a downtrend. And this is done on the 15-minute chart that I'm using. Okay, after this, what we want to do is we want to glance at the longer term line chart just to get a bit of context about the potential trade. As I said, it really, really is important that you understand this. Context is everything about trading. So we'll glance over to the line chart just to put some context around the trade. Now, if we decide that the trade is one that we want to take, then what we're going to do is we're going to wait for the 15-minute candle to break and close beyond the trend line. All right. Once that 15-minute candle has done that, what we'll then do is we'll wait for the price action just to move a few pips past the high or the low of the breakout candle, obviously depending on the direction that you're trading in. Okay, and that's our signal to enter. It's as easy as that. Easy peasy, lemon squeezy. But surprisingly, very, very effective. Okay. Now, if you're one of these people that are a bit more conservative and you feel like taking an immediate break is a bit too risky, maybe a bit too aggressive, because you've seen lots of false breakouts out there, then you could perhaps sort of wait for confirmation. So you wait for a break here, then you wait for a pullback in the price action, and then once that pullback is over, then you get involved in the price. You can do that as well, or you could have sort of like a hybrid of both of them, right? So one of the things that I do sometimes is I will split my position up into, 2 or 3 different chunks, and I will enter on the immediate break. And then if it completely goes with me, fair enough. I make a little bit of profit, which is nice. If it turns around and goes completely against me, I've only lost a little bit, which is fine too. But if we get sort of like a bit of consolidation and then the market breaks down again, then I will add another position to it. So what I'm trying to do here is I kind of address my urge to be involved in every single move of the market, all right, by putting on a small position. But then I'm a little bit more conservative in that I'll wait for price consolidation or a pullback to be able to put all of the position on, if you see what I mean. So it's kind of building into a position. And this is ultimately what it would look like, okay? So you've got a trend looking at this one here. We've got a trend on the 15-minute chart. You can see the market's moving up and up and up. So we draw a trend line along the lows, right? Once we've done that, we then take a look at the 4-hour line chart to see what direction is the market going in. And in this instance here, the market isn't really going anywhere. Okay, so we would expect really that the market would come down to these lows again, but we're not necessarily expecting that it's going to break out all the way down to these lows here. So we wouldn't try and hold a trade for that long. All right, we just basically trade it down towards the lows and then sort of take profit around the lows there. So what you do, and the reason I have Heikin-Ashi candles and normal candles is that sometimes Heikin-Ashi candles can just kind of clear up the price action a little bit for you. Okay, sometimes not, but having all of these charts here just gives me a nice little view of all of the markets. So the market breaks down, closes beneath the trend line, which is on this candle here. You would eventually be in when this candle was broken, the low, so around this candle here. The market goes with you somewhat. Now your take profits is either the lows, which is what it was for us, or you could do like a 1-to-1 above the highs. That's fine too. This market actually went against us a little bit before eventually breaking down. And this is what I'm talking about. You could have taken this initial break here with a smaller position, waited for the consolidation, which you get here, and then eventually added to the position once the market breaks these lows there. Okay, now in this instance, you would have got your second position would have gotten a little bit longer. Hold on, there's a question coming in. In this instance, you would have been in a little bit later than if you put both positions on there, but at the same time, if it went against you, you wouldn't have lost as much. Why do you use Heikin-Ashi and regular charts as they show essentially the same price action? As I said, sometimes it just clears it up for me. It does show essentially the same price action there on the same time frame, but particularly when you're holding trades and stuff, I find it just helps me a little bit. You don't have to do it, but that's what I use. Make sense, Mohit? Well, you see, the bias isn't based on the 4-hour as such. I mean, the 4-hour gives us context, so it lets us know how much we're likely to get out of a trade, but it's not necessarily that it gives us a bias. Obviously, if we're in a monstrous downtrend and we're trading this opportunity here, we're going to have more confidence about it. But the 4-hour chart really is just to give us context and make us understand what we can expect from a trade. You see, that's one of the things that really isn't taught a lot to retail traders, this whole idea of expectation. right? They're kind of, people want to teach you a set and forget system and say, you don't need to think, you don't need to engage your brain. 90% of the people out there, that's what they're teaching, but 90% of the traders out there are losing money as well. So at some point, you've got to sit there and think, well, is not quite right here. Something's not working. What is that? Okay, and that's to me, that's the fact that trading is like a living organism, so to speak. It's this living, breathing thing that you can't necessarily just wrap black and white rules around it and expect, the same result every single time. I'm not saying that there aren't people out there that can't make money of robots and things like that. That would be stupid to say that. But I just think personally, if you're trading a discretionary system like the one that I'm teaching you here, context and expectation is extremely important. You and I know what we're expecting out of a trade. If we look at this chart here, if you've been studying price action for a while, the market breaks down, you expect the market to come down and test the lows. Right? But looking at this price action here, it's also consolidation. So you're not necessarily expecting those lows to be broken. If this was a massive downtrend, like back here, for example, you see it's going down, 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 and then the market breaks the lows, then you're expecting it to move on and make, more significant levels. So it's all about context. And I know that there will be a fair amount of you that don't want to hear that. But trust me, after you've been doing this for a while, it is really one of the most important things. Here's another example on the pound Aussie that we've recently taken. Basically, you had the pound Aussie was kind of broke up. It broke up for a structure level here. We got a nice area, a nice sort of trending price action on the 15-minute chart. So you got 1-2 touches there. Typically, you like to have at least, well, you need to. Having 3 touches is even better. But you draw your trend line along the top there, like that. You then wait for the market to break and close above, which it does there. That would then get you involved in the trade somewhere around this cluster of candles here. Your stop initially is below the lows. So you don't get stopped out, and then eventually the market goes off and pays you. Taking the hybrid entry model that we talked about, you could put on half a position here, wait till the market goes sideways and consolidates a bit. Then when it breaks out above the high eventually, then you can put on another position. And you can see in this instance, you're almost getting in at exactly the same point as your first entry. And all you've done there is you've just mitigated your risk very slightly because you're not putting everything on the trade initially. You're waiting for it to prove to you that it works. Now, it could be that you do things like that and then the market just, goes off and doesn't give you an opportunity to put the second trade on. And sometimes, that's just what you've got to live with. But you have to remember that trading is as much about preserving your capital and protecting your bank as it is about making money. You will make money. If you have a good strategy and you've sorted out your mental state, so to speak, your psychology, you will make money, but you will also lose money. You need to make sure that those effects of losing trades and losing money doesn't affect your ability to make money. So taking smaller position sizes will enable you to do exactly that. The moving average is exponential. Yes, it is indeed. 100 exponential moving average. There's a question here. You use the 15-minute, however, you zoom out quite a lot. How long time are you usually looking at? It's easy to get into the net. Yeah, I mean, it really, really is. In terms of how long are you looking at, it's not a specific amount of time, Hans. It's more to do with the patterns on the chart. We're not trying to look at this little bit here as being a pullback. We're looking for real swings in the market. Okay, you're looking for actual swings. Once you've got those actual swings, then you can get involved in the trade. Does that make sense? So you're not just sometimes, you'll just draw a trend line along the bottom of a pullback, and there won't be really sort of like big swings in the market. You're just waiting for you're just looking for an excuse to get into the market, which is fine. There's no problem with that. But for this strategy here, we're looking for actual swings. We're looking for the market to come away, pull back, come away, pull back, come away, break the level, and then we get involved. Does that make sense? So the stop loss, you initially place it above the swing high. But then when the market moves with you, you're welcome to kind of move your stop behind the more recent swing highs. And that's if you're looking for a sell trade. If you're buying, then your stop initially goes behind the swing lows. And then you can move your stop up as you get higher and higher swing lows. Sorry, another question came in here. In terms of deciding the trend line, we should look for 3 touches and a rejection for it to be valid. 2 touches is kind of enough for me, but 3 touches is better. Yes, indeed. Context is always key. Now, to look at the final slide before we look at some live charts, the take profit, all right, you're looking for a minimum of 1-to-1. You don't want to be getting involved in trades if you know from the outset that it's unlikely your trade has room to make at least 1-to-1 in terms of reward to risk. So if you were risking 20 pips, you would be trying to make 20 pips as well. Taking profits is quite a personal thing, though. All right. So, and the reason that I say that is you need to ask yourself, what type of a person are you? So I like, now I've grown as a trader, I like sort of waiting for the highs and lows to be sort of reached or approached. So I'm much more willing to hold a trade for a longer amount of time now than I was previously. But I know that means that I'm going to get the market swing against me. And I know that means that sometimes I'll be looking at significant profit and that will turn into a break even or a loss. However, if you're not one of these people that can do that, then you don't necessarily want to look for targets that are as far away. You might look for shorter term targets. You might use a fixed ratio like 1-to-1 or 2-to-1. Maybe you'll use a trailing stop. So you just keep moving the stop behind the market and then eventually you'll get out. Now you have to decide for yourself what one works best for you. There isn't kind of like a one size fits all. And this is really what you have to understand about trading. It's about context. Context is everything. Now let's take a look at some charts so we can see how this sort of plays out. We've got this here on the New Zealand dollar, which I'm currently short. And actually this one here, you can see that the market, we've got 1, 2, 3-ish touches. So 1 here, 2 here, 3 there. Got involved in this trade here. I have got quite a lot of sort of like fundamental bias with this particular trade here, but nevertheless, it did take me out. So eventually I got taken out of this trade here, but I re-entered when we got this big candle back on the back of the FOMC earlier on this week. Re-entered this trade here and currently short and looking to add to the position if it breaks beneath these lows here. All right. But let's go and take a look at one that I haven't taken, or look at identifying them on our charts here so you can see how you sort of draw them in. And you're only looking for the most obvious levels, right? In fact, let's go back to that one. There were some obvious levels here. So the way that you're looking to draw in your trend line is you want the most obvious level. So in this instance here, that would be, so you'd start with your trend line there. Then the market obviously came and broke through here. We would then adjust the trend line very slightly. Okay, and this isn't one that we're in, but it's a valid trade. When the market breaks on this candle here, you would then be in a couple of pips below that candle. Since then, the market's gone against you a little bit. It hasn't stopped you out. but it looks like the market is going to go lower. So this looks like a good opportunity. Okay. Let's try and find. So I've marked up all of these charts. Okay, so here's another good example. Aussie dollar is something that we've been looking to short for flipping weeks now. And eventually we get the opportunity. Okay, so you can see that the market is moving up quite nicely. You get 1-2 touches, and then the market eventually breaks down over here. You could also have a trend line in like this, although it's be more of a sort of like a horizontal line, if you like. But you could also do that. What you don't want to do when you're putting your trend lines in is we're not looking for this kind of stuff here. All right, we're looking for clear points where the market has, you know, where there are clear swing points. Right, this here is not a clear swing point. I wouldn't draw a trend line like that or like that. Doesn't make any sense. Okay, if we go, let's look at, we were looking at gold recently. So here, for example, you can see the market's got clear swing points. So it's come down to it, it's swung away, it's come back, and then eventually it's broken through. Right, and you can see this, oops, all over the charts here again. Okay, so we drew in our trend line here like this initially. The market broke, but it didn't go beyond this candle, so we didn't get an entry. And what you do there is you basically, oops, you then alter your trend line slightly, so you get the most recent price action, and then you get involved there. If there is a look back period, it would be much more objective, don't you think? Yeah, I do. I know what you mean, Mohit, but the point that I'm trying to get across in this webinar here is that that's the problem. That is the problem. That's the reason that so many retail traders, they don't make money. You know, I'm sorry to say this, but they don't make money because of exactly what you're saying there. They're looking for like this black and white, clearly defined rules. And then they wonder why it doesn't work. It's because the markets are always changing. So if you're looking for that sort of like black and white 1, 2, 3, you know, draw your trend line over 3 weeks. You know, it's got to be 3 weeks. Then you're going to find that you're not getting the right trade. You're forcing the issue. You understand that you need to kind of, to be successful as a trader, you have to accept that there is no perfect, there is no, you know, absolute system that will eliminate losses, that will get you into all of the right trades at the right time. It's about understanding that and moving with the markets. Yeah? So is this making sense to everybody? When we talk about using the 4 hour for context, if you look at this chart here, you can see it breaks a structure low on the 4 hour line chart. So there, when you're getting involved in those trades, then you're expecting the market to kind of break down to new levels. That's where you may hold the trades for a little bit longer. Now, where does this eventually break? It is back in November 11th, right? So where are we? So this is where it breaks in, November 11th. Once the market breaks down there, you can put your trend line in here, like that. That would have got you in, made you some money. Here again. So do you kind of see what I'm saying? Is this making sense to everybody? This is an absolutely phenomenal trading system, and it's one that will make you money for the rest of your life. It's not the most exciting one. You know, there are going to be others with other bells and whistles and stuff like that, but it is one that will make you money over and over again. You know, this trading system has never left our side. The problem that we have with it is teaching people, because this is much more of a discretionary system. And what we found as educators is that trying to teach other traders a system like this, a lot of the time you're just sort of setting yourself up for failure, because traders don't want a super simple strategy like this. They want the black and white, do this every single time and you will get the exact same results every single time. But I promise you put in a bit of effort here, you're going to make a significant amount of money. If you're looking at the Aussie dollar again, you could adjust the trend line up a bit. You would have lost on that trade. Would you have an argument for not taking that trade? Nope, I probably would have taken the trade. Let's go back to where you're talking about. So where would you have... You actually wouldn't have lost. It would have come close to your stop loss. But adjusting it up here... I'm not one of these people, by the way, that place it just 1 pip above. If any of you read our money file, you'll see that I recommend often using sort of like 10, 20 pips above the highs. So this wouldn't have taken me out of the position. Euro dollar. Looking for potential shorting opportunities. Unfortunately, you can actually see our entry up here. That ship has sort of sailed at the moment. There, you're kind of chasing it if you get involved now. You'd be waiting for more of a pullback than this. So at the moment, there's no opportunity. But if the market can kind of trend up towards here, then I would look to take it short again. The opportunity that was there was a break of this low here. So are there any questions about any other questions about the strategy? We've got 5 minutes before we need to wrap it up. So I'll open up the floor now to any other questions that you may have, or any other pairs that you would like to look at. And forgive me if I've sounded quite sort of sleepy or whatever, but as I said, I've got the flu. I've dosed myself up with a serious amount of narcotics, so I'm not the usual kind of what's the word for it? Sprightly self. Natural gas. What's the symbol for that? So nat gas. Looking at this here, the way I would play this is I'd actually ignore that spike candle there for the most part. We can see that on the 4 hour it's clearly up. If we look at previous levels of resistance become supports, it's exactly where the market's at right now. So now we're waiting for the market to break up above here, and that'll be quite a good long opportunity. In terms of trades a week or a month, some weeks there aren't many. Other weeks you could have sort of like 10, 15 trades set up. But I guess if you look at it on an average, you should be having 5 to 10 trades a week. Oh, I've got a question in the Q&A box. Sorry, I didn't see that. Georg is off. Oh, okay. Thanks for watching, and see you soon. So does... Oh, you're welcome. You're most welcome, Pan. You're most welcome, Hans. So there are no other questions? No? Okie dokie. Well, if there are no other questions, then we'll wrap it up here. I'll give you back 3 minutes of your life, or 2 minutes now. 2 minutes of your life. The clock's just gone to 43. Um, I'd like to thank everybody for joining today, and thank those of you watching the recordings. As I said, this is the last webinar of 2016. I hope you all enjoyed it. I genuinely believe I've given you the best strategy possible on this final webinar here, so please use it. This is definitely an early Christmas present for you all. I will see you all again in 2017 with our one webinar a month. If you've got any requests in terms of subjects that you'd like us to cover, please feel free to drop me an email. That's alex@traderscorner.co.uk. Drop me an email, and we'll make sure they're included. Otherwise, have a really very Merry Christmas, everybody. Happy holidays, and I'll see you all soon. Thank you so much, and thank you to FX Street for having us, as always. Take care, all. Goodbye. Yes, Mohit, 4 hours the line chart.